The financial markets are entering a phase marked by heightened tension and rapid price movement, with precious metals emerging at the center of investor attention. Across global exchanges, gold and silver are no longer behaving as quiet hedges, but as active indicators of stress within the broader monetary system. Prices are moving sharply, volatility is elevated, and traditional reference points are beginning to shift. What was once gradual now appears abrupt, and what was once dismissed as temporary is increasingly treated as structural. Silver and gold are rising at the same time that confidence in the US dollar is visibly eroding. This combination is drawing capital into metals markets not through speculation alone, but through growing concern about currency stability. Investors are responding to signals that suggest something more than routine market fluctuation. The movement is not isolated to a single metal or exchange. It spans regions, instruments, and investor categories, reinforcing the sense that a larger transition may be unfolding. The environment is defined by urgency. Market participants are reacting quickly, often driven by fear of missing out as prices accelerate. In this atmosphere, silver has taken on renewed importance, not just as an industrial metal, but as a practical alternative for those priced out of gold. Gold itself continues to assert its role as a monetary benchmark, reaching levels that force reassessment of previous assumptions about valuation and risk. At the same time, the US dollar is experiencing a notable decline, reaching levels not seen in a long period. This weakness is not treated as a routine correction. It is being interpreted as a meaningful development with direct consequences for asset pricing. The relationship between currency strength and precious metals is becoming increasingly visible, and the dollar's movement is amplifying momentum across metals markets. Together, these forces are reshaping market behavior. Precious metals are no longer reacting quietly in the background. They are signaling stress, adjustment, and uncertainty within the global financial system, setting the stage for deeper examination of price movements, investor behavior, and the shifting balance between currencies and tangible assets. Silver has emerged as one of the most dynamic assets in the current market environment, posting a sharp and highly visible recovery. After experiencing recent losses, the metal has rebounded forcefully, rising by more than 8% and reaching a price of $112.37. This move represents not just a numerical gain, but a decisive shift in momentum. The speed of the recovery has drawn attention from both traders and longer-term investors, many of whom had been watching for confirmation that silver's weakness was temporary rather than structural. The rebound suggests that underlying demand remains intact, rather than retreating after its earlier decline. Silver attracted renewed buying interest as prices began to climb. This behavior reflects a market that is increasingly sensitive to macroeconomic signals and currency movement. As confidence in the US dollar weakens, silver is benefiting from its dual identity as both a precious metal and a widely traded alternative store of value. The price action in New York markets has been particularly important. The rise to 112.37 has reestablished silver as a leading performer within the metals complex for the day, outpacing several peers and reinforcing its role as a vehicle for capital-seeking exposure to tangible assets. The move also highlights how quickly sentiment can change in an environment dominated by volatility and fear of missing out. Investor behavior during this surge points to urgency rather than caution. Buyers are stepping in rapidly, motivated by the perception that opportunities may disappear as prices move higher. This dynamic contributes to sharper price swings as demand concentrates into short time frames rather than spreading evenly over longer periods. The result is a market that reacts strongly to momentum, with silver positioned at the center of that reaction. This recovery does not exist in isolation. It forms part of a broader pattern in which precious metals are reasserting themselves amid uncertainty. Silver's performance in New York is one expression of this trend, setting the stage for comparisons with other global markets where price behavior has become even more extreme. While silver's recovery in New York has been notable, price action in Shanghai has taken on even greater significance. Silver prices on the Shanghai market have reached a new all-time high at 128.45, marking a level not previously recorded. This development immediately sets Shanghai apart from other major trading centers and introduces a sharp contrast in how silver is being valued across regions. The gap between Shanghai and New York prices is substantial. With New York silver trading significantly lower than Shanghai, an arbitrage opportunity has opened that is difficult for the market to ignore. Such a divergence signals that demand conditions are not evenly balanced across global exchanges. Instead, it suggests concentrated buying pressure in Shanghai that is strong enough to push prices far beyond levels seen elsewhere. This price disparity highlights how regional forces can influence global commodities. Silver is a globally traded metal, yet its valuation is being pulled in different directions depending on location. The higher prices in Shanghai indicate a market willing to pay a premium, reinforcing the idea that physical demand and local market dynamics are playing a decisive role. At the same time, New York prices appear comparatively restrained. amplifying the contrast rather than smoothing it out. Arbitrage opportunities of this scale introduce tension into the system. When price differences widen, they draw attention from traders and institutions looking to exploit inefficiencies. Even without immediate correction, the existence of such a gap alters expectations. It forces participants to reassess whether current prices accurately reflect demand or whether further adjustments are likely. The Shanghai Silver Record does more than set a headline. It underscores the intensity of current market conditions and reinforces the sense that silver is experiencing pressure from multiple directions at once. This divergence between markets strengthens the narrative of volatility and imbalance, adding another layer to an already unsettled precious metals landscape. Alongside silver's sharp movements, gold has continued to assert its dominance within the precious metals market by reaching a new record high. The metal has risen by 3.47%, pushing its price to $584.90. This advance reinforces gold's position as the primary reference point for investors seeking stability during periods of uncertainty. Unlike short-term fluctuations, a move to a record level carries symbolic weight, signaling that demand remains strong even at elevated prices. Gold's rise is unfolding in parallel with silver's surge, but it carries a different kind of significance. While silver is often associated with volatility and rapid shifts in sentiment, gold's steady climb to new highs reflects sustained confidence in its role as a monetary asset. Investors appear willing to commit capital at increasingly higher levels, suggesting that concerns driving demand have not been resolved. The timing of gold's record is also notable. It occurs in an environment already marked by currency weakness and market instability, amplifying its importance. Gold is not reacting in isolation. It is responding to the same pressures affecting silver, yet expressing them through a more measured and historically consistent pattern of behavior. The rise reinforces the idea that safe haven demand remains active and persistent. This record level forces a reassessment of expectations. Prices that once seemed extreme are now being accepted as the new baseline. As gold moves higher, it reshapes the psychological framework of the market, influencing how investors interpret value, risk, and protection. The move also strengthens gold's role as a benchmark against which other metals, including silver, are measured. Gold's performance adds another layer to the broader picture of precious metals' strength. Together with silver's volatility, it confirms that capital is flowing decisively into tangible assets, driven by forces that extend beyond short-term trading and into deeper concerns about financial stability. Beyond gold and silver, other precious metals are also reflecting the uneven and selective nature of the current market environment. Platinum has posted a gain of 1.9%, reaching a price of $2,637 per ounce. This increase places platinum firmly in positive territory for the day, aligning it with the broader upward trend seen across much of the metals complex. Its movement suggests that investor interest is not limited to a single asset, but is spreading across multiple metals, though not uniformly. Palladium, however, stands apart from this pattern. It is the only major precious metal registering a decline, falling by 1.7% to 1,950. This divergence highlights the fragmented nature of the market. While some metals benefit from the same forces driving gold and silver higher, others are not attracting the same level of demand. Palladium's decline underscores that the current environment is not lifting all assets equally, and that market participants are making selective choices rather than broad allocations. Rhodium has shown modest upward movement, gaining 50 to reach 11,250. Although less frequently discussed than other metals, its price action contributes to the overall picture of mixed performance within the sector. The relatively small increase contrasts with the more dramatic movement seen in gold and silver, reinforcing the idea that volatility is concentrated in specific areas rather than spread evenly. Taken together, these movements reveal a market characterized by differentiation rather than uniformity. Precious metals are responding to shared macroeconomic pressures, yet each metal is expressing those pressures differently. This uneven performance highlights the complexity of the current landscape, where broader trends coexist with asset-specific dynamics, adding to the sense of uncertainty and heightened scrutiny across the metals market. One of the key indicators drawing attention in the current market is the gold-to-silver ratio, which has moved to 46.17. This level places the ratio well below 47, a threshold that market participants closely monitor. The ratio reflects the relative pricing of gold compared to silver, and changes in this figure can signal shifts in investor preference between the two metals. At this level, the ratio suggests that silver has been gaining strength relative to gold. As silver prices rise at a faster pace, the ratio compresses, indicating that investors are increasingly favoring silver or viewing it as comparatively undervalued within the precious metal space. This shift aligns with the broader behavior observed in the market, where silver is attracting heightened interest amid volatility and rising prices. The movement of the ratio is not an isolated metric. It functions as a summary of broader market dynamics, capturing how capital is being allocated between metals that serve overlapping but distinct roles. Gold continues to act as a primary store of value, while silver's lower price point and growing momentum make it an appealing alternative, particularly in an environment shaped by urgency and fear of missing out. A ratio below 47 reinforces the idea that silver is no longer lagging behind gold in the way it often does during more stable periods. Instead, it is asserting itself more aggressively, narrowing the gap between the two. This compression reflects changing perceptions about risk, affordability, and opportunity within the precious metals market. The gold to silver ratio, at its current level, adds another layer to the narrative of imbalance and adjustment. It confirms that recent price movements are not random, but interconnected, revealing how shifts in sentiment and demand are reshaping relationships that investors rely on to interpret market direction. The current market environment is defined by elevated volatility and rapid shifts in sentiment. Prices are moving aggressively, and reactions are often driven less by patience and more by urgency. Investors are responding to a landscape where hesitation carries perceived risk, and momentum itself becomes a powerful force. This volatility is not confined to isolated moments. It is sustained by a combination of macroeconomic uncertainty and geopolitical pressure that continues to influence decision-making. Fear of missing out has become a dominant psychological driver. As prices rise, particularly in silver, investors are motivated by the concern that waiting may result in lost opportunity. This behavior accelerates buying activity, compressing decision timelines and amplifying price swings. Rather than entering the market gradually, participants are acting decisively, reinforcing upward momentum and increasing short-term instability. Within this context, silver is increasingly being used as a substitute for gold. As gold reaches record highs, its accessibility becomes more limited for some investors. Silver, with its lower price point, offers an alternative path into precious metals exposure. This substitution effect channels additional demand into silver, strengthening its price performance and tying its movement closely to gold's trajectory. Macroeconomic and geopolitical factors underpin this behavior, shaping expectations and heightening sensitivity to market signals. While these forces are complex, their impact is clearly visible in how quickly sentiment shifts and how strongly prices respond. The metals market is absorbing these pressures in real time, translating uncertainty into volatility. Despite the emphasis on momentum and psychology, physical demand remains central to the market structure. Price movements may be accelerated by emotion, but they are anchored by tangible demand for metal. This balance between speculative urgency and underlying physical interest contributes to the intensity of current conditions, setting the stage for continued instability as long as these drivers remain in place. Physical demand continues to play a critical role in shaping silver's market trajectory, even as price volatility attracts speculative attention. While industrial applications account for roughly 60% of total silver consumption, the portion tied to physical investment, coins, bars, and other forms of tangible holdings, remains a central factor in pricing dynamics. This demand acts as a stabilizing force, ensuring that upward price movement is supported by real-world use rather than purely by market sentiment. The industrial component of silver consumption, though significant, is less reactive to short-term price swings. Manufacturing and technological applications require a steady supply, and changes in these sectors unfold gradually. In contrast, physical investment responds quickly to market signals, particularly during periods of macroeconomic uncertainty or currency weakness. Investors seeking to preserve value or hedge against volatility are actively acquiring tangible silver, reinforcing upward pressure on prices. This distinction highlights the dual nature of silver's market. It is both a functional industrial commodity and a store of value. The strength of physical demand ensures that price movements are grounded in actual consumption patterns, not just speculative trades. Without this component, the recent surge would be far more vulnerable to reversal, but sustained physical interest lends credibility and weight to the rally. In the current environment, the interplay between industrial demand and physical investment amplifies volatility while providing an anchor. Physical silver acquisition is not simply an adjunct to trading activity. It is an essential driver that influences market behavior, arbitrage opportunities, and regional price disparities. Understanding this balance is crucial for interpreting silver's recent gains and assessing the sustainability of its momentum in a period of broader financial uncertainty. The US dollar is experiencing a significant and sustained decline, a movement that has immediate and far-reaching implications for the global financial system. Currently, down 1.29% to 95.85, the currency has reached levels not seen in recent memory. This decline is more than a routine fluctuation. It represents a notable shift in investor confidence and has become a key factor influencing asset prices, particularly in the precious metal sector. The weakness of the dollar amplifies the appeal of assets denominated outside of it, particularly gold and silver. As the currency loses value, Investors seek to preserve purchasing power by allocating capital into metals that are widely recognized as stores of value. The correlation is clear. As the dollar declines, the prices of gold and silver rise, reinforcing the metal's roles as hedges against currency erosion. Market participants are closely monitoring this trend because it is not merely incremental. It signals a potentially broader rebalancing of capital. Analysts and investors alike are interpreting the dollar's slide as a shifting story, one that could redefine traditional assumptions about monetary stability and influence future allocation decisions. The speed and magnitude of the decline have caught attention, intensifying both concern and opportunity across financial markets. This weakening dollar does not operate in isolation. It interacts with broader macroeconomic conditions, investor sentiment, and regional demand patterns to influence the flow of capital. The decline in value serves as both a trigger and a reinforcement mechanism for rising precious metals prices. In effect, it amplifies trends already in motion, creating a feedback loop where metals benefit from both intrinsic demand and the relative weakness of the currency. Understanding the dollar's movement is essential to interpreting current market dynamics. Its decline shapes investor behavior, influences arbitrage opportunities, and provides context for the dramatic price shifts observed in both silver and gold. In this environment, the dollar is not simply a backdrop. It is an active driver of the trends that are redefining the landscape of precious metals investment. The decline of the US dollar has reinforced the broader upward trajectory of precious metals, creating a clear link between currency weakness and asset appreciation. As the dollar falls, both gold and silver have absorbed the impact, with prices rising in response to the erosion of traditional currency value. This dynamic underscores a fundamental principle of the current market. Tangible assets, particularly metals, are benefiting directly from shifts in monetary confidence. Investors are responding to the dollar's slide with increased allocation to gold and silver, recognizing that these metals provide protection against the declining purchasing power of the currency. The rise in prices is not random, but is systematically connected to this weakening, forming a consistent pattern across multiple exchanges and regions. In effect, the dollar's movement acts as both a catalyst and a supporting force for metals, reinforcing existing momentum while attracting additional capital into the market. This connection also highlights the interplay between market psychology and real economic factors. As the dollar loses strength, the urgency to secure alternative stores of value intensifies. Silver, with its lower entry point compared to gold, becomes a particularly attractive option, while gold continues to command respect as the primary safe haven asset. Together, they form a dual response to currency instability, each serving slightly different roles within investor portfolios, but united by the common driver of dollar weakness. The implications of this relationship extend beyond short-term price movements. The dollar's decline and its effect on metals prices serve as an indicator of broader systemic shifts, signaling changes in risk perception, asset allocation, and market priorities. By connecting the performance of gold and silver directly to currency trends, the market reflects both immediate reactions and the underlying forces shaping investor behavior, emphasizing the significance of tangible assets in a period of monetary uncertainty. This alignment between dollar weakness and rising precious metals solidifies the narrative of the current market environment, one of volatility, selective demand, and the increasing centrality of tangible assets as stores of value amid shifting economic conditions.